And you're going to kick it off, B. Bennett. Oh, we lost Bennett. Hold on. I got you. Hang on. I got you, Bennett. Okay, Bennett's. Your audio's back on, Bennett.
All right. You got me now?
Yes. Yep, take it away.
All
You're
right.
obviously you're going to open
Waiting
it.
to. We're live. It looks like we're working. Hey, what's going on, guys? Traders, investors, welcome to the Wednesday live stream show. We do apologize for the technical difficulties getting started. The past couple of Wednesdays here in the office, I've had some bandwidth issues with my internet provider, as well as the backup internet. So we apologize again for getting started late. Glad you guys are here to join us this morning. Upside continues in the markets. Last couple weeks back, we were looking at the idea that the February 24th of the wave 4 correction. We've seen some fairly significant progress, approaching the 61% retracement of that decline. So let's jump into it here. Good morning, Todd. Good morning, Terry. How are you guys today?
Good. Hey, Terry. Hey, Bennett. How you guys doing?
Oh man, as good as always, and as good as we can be with the technical difficulties, huh?
Yeah. Terry, are you able to hear okay? Oh, we lost him. So let me just see. Sorry, guys. So I'm coming in kind of pinch hitter here, guys. Bennett's having issues on his end with bandwidth.
Yeah, I can hear.
Oh, you're back. Okay, there you go.
Yeah, I can hear. Yes.
Oh, okay. Anyways,
okay,
yeah.
looks like okay. Look, we're streaming now. I see it.
So we just threw this together. I dusted off the old streaming software, threw this together for the team. What's up, guys? I'm here to support. I'm in a support role. So Bennett and Terry, take it away, guys.
All right.
I appreciate it. I really do. It's always every now and again you got to have at least a couple of times a year when either your internet provider or your streaming software just gives you some issues. So no, we appreciate you jumping in there and offering to do that. We just couldn't miss 2 weeks. Last week I had issues with my internet provider. If you guys are aware, I'm sure you're aware if you watch the news, we've had some pretty crazy weather here in the great state of Texas. The first day of spring was met with tornado warnings, hailstorms. We actually had multiple, I guess that would be E2 tornadoes touching down. Ran to the store and as I'm checking out, yeah, I touched down in Round Rock. And as I was leaving the store, the tornado warning started going off. And, you know, I tell you what, we hear that once a month for the, they do a test every Saturday, one Saturday a month. And so I'm used to hearing it when the weather's good, but not when there's, you know, a downpour and actual weather conditions. So good times with that. But glad to be here. We wanted to bring you an update regarding the status in the indexes. We're going to get to the charts here. Terry can take you through some sector rotation. Todd, if you could bring up my screen share, I'm going to attempt to take them into Motive Wave now.
Go right ahead. And obviously,
Perfect.
Bennett doesn't have enough bandwidth to stream video, so we have a little image stand-in. But take it away. It looks good from my point of view.
You would think in this day and age, I tell you what, we all need like 5 gigabit, you know, connections, both upstream and downstream. Someday we'll get there.
Starlink can't get here soon enough. Let me tell you.
I think that's pretty awesome. So hey, let's hit it. We've had some good discussions in regards to the Elliott Wave structure from the COVID lows, and I continue to personally operate under the count that would suggest we've only had 2 actionary waves and either 1 or 2 correction. What that means is in terms of the motive impulsive count, we see our first wave 1 completing September of 2020. That's when we're met with the largest correction post-COVID low. So this would suggest, as an Elliottician, that is your highest degree of trend pullback. From there, we have another clear 5-wave rally. This particular 5-wave rally has 2 corrections of the same degree, which tend towards equality. validity of the impulse from October 31st of 2020 all the way in through January 4th of 2022. So where that leaves us in terms of the wave count is, number one, our preferred view, which suggests we are at or nearing the end of Orange Wave 4. Orange Wave 4 in the S&P likely completed the February 24th low, and we're now working our way out into the higher degree Wave 5. We've tracked an alternate view to have context in the event, let's say, markets were met with a secondary decline. And that alternate view would entertain the idea that the three-wave structure into the January highs, because remember, in our preferred view, we have wave 1, wave 2, up in wave 3. We know three waves cannot complete a trend, in this case, a motive impulsive trend. So the alternate view that would allow for a more significant retracement of the rally from the COVID low would be the view that suggests that three-wave move was an ABC rally as opposed to this being 1, 2, and 3. I don't think we're here. There are some charts that are challenging the bullish view, which suggest wave 4 is over. Those charts include consumer discretionary, around 12.5% of the index. So we are acknowledging the possibility that this is a corrective rally into the 618 or 786 retracement of the decline. But we're not tracking this as our preferred view. This is our back of the pocket plan B alternate. So back to the preferred view suggesting the February 24th low marks the end of the correction. I'm going to get you off of the daily now and take you to the 1 hour chart. If you attended our recent webinar, I sent everybody home with a, excuse me, sent everybody home with a PDF guide kind of breaking down the two distinct possibilities. In our preferred view was the idea that the February 24th low that you see middle of your screen was the end of Orange primary wave 4. We have our first 5-wave motive rally, a 3-wave pullback. We had a good test of the 618 and even 786 retracement. If you go back to the March 8th low, we pushed just below the 618 or the 786. We rally back in B, complete lower down in C. And then we continue up into the March Fed meeting. And into the March Fed meeting, when the announcement was released, we did see some intraday volatility. In our opinion, that has proved to be the wave 2 of higher green minor wave 3. It was a perfect 61% retracement, and now we see a nice 5-wave rally up into the 618. So we're up against a zone of resistance here in Orange Wave 3 of higher degree Green Wave 3. I'll go ahead and bring this in 1 degree at a time. We are expecting some near-term volatility in Orange Wave 4, potentially back to 44.28. From there, we expect to move up to complete Green Wave 3. Green Wave 3 has its 1618 relationship to Green 1 at 46.6727. That's a significant level for the S&P in that it is exactly in line with the 786 retracement of the entire decline, peak to trough, January highs into February lows. Now, in terms of dismissing the alternate view, let me show you what I'm looking at. Over in the alternate view would suggest that we've simply been in a corrective retracement or a corrective rally. There is some hesitation in regards to this particular count, in that in order to view this as an appropriate motive wave, but on a closing basis, there's actually isolation between the corrections. So it's valid to be viewed as a motive impulsive wave. You might be thinking, well, gosh, with the overlap, can't you call it a diagonal? Technically, it would fail to meet the requirements of an expanding diagonal. And we know expanding diagonals are fairly rare. So looking at this, if this is truly a corrective rally, we would anticipate the next upside test of resistance, which could have been yesterday's high, resulting in an impulsive move to the downside. Where in our preferred view, if in fact this is upside resumption to the 1618 and 786 retracement, we expect Orange Wave 4 to pair up to Orange Wave 2, which occurred March 16th. And at that point, we should have continuation. So all signs are continuing to point on the upside. Over to the Nasdaq, in the Nasdaq 100, we have a very similar wave count. Unlike the S&P, the Nasdaq proceeded to make a new low into March 14th. The S&P, in our preferred view, calls the February 24th low the end of orange wave 4, where in this case, we actually make a new low March 14th. So what that does for us is it leaves us with one fewer degree of trend, and that's fine. We don't have to have perfect pairing of the S&P and the Nasdaq in terms of the subdivisions. So zooming in here on the NDX, and I'm going to take you down to a 15-minute chart to get a little bit better of a view here. We have a very similar wave structure in development from the 14th. We have a move up into the high of the 16th, the decline into the 16th post-Fed announcement, rallying into the press conference, and now we have evidence of a smaller 5-wave trend. On the 21st, we were expecting the 38% retracement to hold as a first sign approaching resistance 14,757 up to 14,916. That should give us a wave 4 to pair up to wave 2, then a move up in 5, then a little ABC pullback, and that should then set us up for the more significant rally in wave 3, which I would anticipate taking us into new highs for the index. And then alternatively, we do still have that alternate view at our disposal in terms of this potentially being a corrective rally. In order to arrive at a wave count, which would suggest the recent index lows was just simply the first wave of the decline, we kind of have to force the view. We have to force an initial leading diagonal here. You're then met with a fairly sharp wave 2. We also have to entertain truncation of this orange wave 5 inside of green wave 3. So this is why it continues to remain an alternate view and is not our preferred. This particular count would suggest resistance between the 50 and 61% retracement would result in an impulsive move to the downside. So that's it for me in the Nasdaq and the S&P. Let's take a quick look at the Russell 2000. I do see a request for that. The Russell 2000, in addition to the consumer discretionary sector chart, is one of the charts which kind of challenges the wave 4 view. It's not wrong in that we do have positive alternation to the wave 2 of the same degree. This is a more directional, complex trend pairing up to a sideways flat. And if you'll notice here, I apologize for the motive wave jumping on you. If you'll notice, the market's been attempting to put up a fight at the 38% retracement of the orange wave 3. And taking you down to the 195-minute half-day chart, we do see evidence from the February 24th 786 and kind of a similar upside progression there. There is an alternate view here as well that would suggest we've done 5 waves to the downside. If we are really 5 waves to the downside, watch upside resistance here between 2109 and 21.5. You could potentially see the 618, but if this is a corrective rally, I think we'll shut down before the 618. So that's it from me in terms of the indexes. Again, just to reiterate our view in the S&P 500, in the near term, we expect resistance at the 618 near 45.36 to 45.62. Give us a pullback in orange wave 4. If we see a corrective structure here, I'm looking to go along with clients in the index up to the 1618 of the higher degree. Then we'll see a wave 4 to pair up to wave 2. Probably a move into new highs, then a 3-wave pullback, and then the continuation development to our 2022 S&P targets. Watch the alternate zone of resistance that we have over here in our yellow count, which would suggest this is simply 3 waves back. If this is truly 3 waves back, I would not anticipate an additional 3-4 move and then continuation. I would probably be viewing the move into the 21st as wave 4 of wave C of what would be a 3-wave retracement in this alternate view. All right, so that's it from me. You guys want to jump over and take a look at Optima? I'll pass the screen to Terry, unless we want to jump over to the advisor's corner. And
no, I want to.
Todd Gordon of New Age.
I want to hear what Terry says. I mean, I don't know about you guys, but just I just find it amazing how quickly how quickly sentiment changed. How, you know, just over the last week or two. just running portfolios, trying the clients that we have are great. We heard, actually I didn't get a single concern call on the sell off here. We've been in contact at the wealth management business, just like we set up the culture here at Trading Analysis. And it's amazing how quickly the sentiment changed, number one. And number two, I'm interested to see where Terry goes. I don't know what he has on tap for us, but from my point of view, not only were so few people expecting a recovery like we're saying, and everything I just listened to Bennett from the wave counts, which I still rely on heavily, we just are seeing leadership from technology and growth and semis. I mean, I think the sentiment was so extremely bearish, and then if you look at the chances you've put out there of a recovery led by growth and tech, I bet you it was like a negative possibility. I don't know who was talking about it at all. Did you guys notice the same thing, or just talk to me about that?
We'll see. Let me jump on in, and I'll talk about that when I get to the growth sectors there on that. So let's go ahead and start. Hello, traders. I'm Terry Long at TradingAnalysis.com with your weekly sector focus. It's finally spring, and we know that spring is known as the season of renewal. So does this mean a renewal of the bull market as well? Now, unarguably, last week we witnessed a major turning point here in the markets. You can see last week beginning with a little bit of a cold start on Monday. Then the markets rallied sharply higher throughout the remaining of the week, absorbing the Fed's quarter-point rate hike announcement. And the S&P rallied 6.16% in 1 week, recovering all the way back up here to its 50-day moving average. And the NDX followed suit, rising 8.41% in 4 consecutive up sessions to end just shy of its 50-day moving average. Now, the energy sector, it spun the opposite direction last week. You can see here, this is last week's weekly performance of all the sectors. My gosh, have you ever seen such a high bars on all of these sectors, right? So it was a broad rally with just energy playing the contrarian here with the high volatility in the energy sector. Excuse me while I itch my nose. So utility sector also right here, the utility sector made just a slight 0.54% gain. Sorry, I got the mouse on the wrong place there. There you go. You can see your mouse. Here's the energy sector. And then here is the utility sector, just a slight 0.54% gain. Now, consumer discretionary rallied over 9%. Technology sector rose 7.64%. And this is what Todd is talking about here, this huge run up here, right? The financial sector also reversed nicely, up 7.14%. Now, let's fast forward to this week. And then Monday's price action here, markets look to take a pause, actually, and a breather. And I was kind of wondering what I was seeing here in this particular candle formation. But ultimately, we accelerated further on Tuesday, seeing the S&P netting a 1.09% for the week. Let's go ahead and pull this little table over here. This shows you current, this is Monday and Tuesday's price action. The S&P up 1.09, the Nasdaq up 1.62, and you can just see a beautiful continuation of that trend. Now, I will say that the S&P in its deepest point took about a 13% decline here, and the Nasdaq took almost a 22% decline. Now, individual stocks, I've seen some with 75% drops. I've seen some with 5% drops. So you need to be selective when you're looking at your stock opportunities. This is Monday and Tuesday's price action here now. We still have 8 out of the 11 sectors in positive territory. Utilities, energy, and real estate going slightly negative here. But it looks like my overnight session, that energy is regaining a bid this morning, because this data in this table here is more live than what we have over there. So I see energy rebounding back up. Let's go ahead and jump into my sector scoreboard here. As expected, we are now seeing a vertical decline in the energy sector, indicating a rapid loss of momentum here, yet its relative strength ratio remains out here almost 120. Last week, we saw the staples sector rise 3.85%, but that was only about half of the benchmark of the S&P. Thus, we see here the vector continuing a southerly direction as momentum fades from there as well. The utility sector is still showing a bit of a turn to the south here, and then zooming in a little bit closer, you can see this is the financial sector. It turned south as well, but I think that's likely more due to the prior week's performance. Now, still, all of these vectors are showing us green leading weekly price trends. The healthcare sector here actually looks to accelerated sharply up into the northeasterly heading. It's gaining both momentum and relative strength simultaneously, still moving in that northeasterly header. Industrials and material, they remain in the leading quadrant, but their performance is just a little bit less than what you're seeing out of these other sectors. Now, the real estate sector has been hanging out down here in the weakening quadrant. If I animate, I'll take you back. You can see how it rotated out of the leading quadrant, pushed down into the weakening. At this point right here, you might say we're headed for the lagging quadrant, but it decided to just yo-yo back and forth. So that stalling out right there is some indecision in the marketplace here. So real estate kind of taking a pause, holding momentum and relative strength fairly constant. So we need to see more near term. The vector did just turn yellow, but without the vector moving much, there's really not much I can say. Now, on the point that Todd, I think, was trying to make. We like to see these hook formations, okay, occur. So yes, we saw our growth stocks in technology and consumer discretionary move down sharply through the weakening quadrant, now into the lagging quadrant. And what we're looking for to get out of this is this northerly hook. Now, I will still say, Todd, that it's not totally confirmed until we get this vector pointing back to the northeast. But we've certainly made some significant ground in reversing the momentum fade in both technology and consumer discretionary. And you can see there's a nice continuation here in discretionary rolling back to the north. Now, I can't say the same here for communications. It's just another one that remains hesitant out here to make any move in any direction. I did see a little bit of positive action out of Google, though, so I'm going to hang on and be hopeful there that we've got something coming. But right now, communication sector, it's not changing momentum. It's not changing relative strength, and the direction of the arrow at this point is not really significant, although it might look like it wants to take another trip back to the lagging quadrant. So it didn't get too far into the improving quadrant there. So it's really interesting to have so many of these sectors in the leading quadrant with the market in the condition it is. And then it's a very positive thing, like I said, to see this. Now I'm going to share, I have my growth and value. We'll talk real quick about this. So I usually focus in on the weekly time frames, and Bennett usually focuses in on the daily. And this is the weekly IVE, IVW. So IVE is value stocks, and IVW is growth stocks in an ETF, right? So we're seeing that vertical rise in momentum out of the lagging quadrant. And this is a rotation, right? So the whole thing is an orbital. That's why we talk sector rotation. And you can see that orbital. You can see that major shift change in value and growth simultaneously, one losing momentum, the other gaining momentum. And here it is on the short term. If we look on a daily time frame, we get the same effect, right? We got a rapid turnover here on March 15th. And that was the key reversal date right there. Now we're seeing growth rapidly shoot through the improving quadrant, value rapidly decaying. And we can look at the detail of all the large cap or small cap growth and value and et cetera here in this table. But I'm going to leave it for that for now. I do want to talk about gold real quick, because we've been tracking gold's performance as we pushed up and reached the $2,060 something all-time high from August 2020. We had came out of a larger triangle pattern, and we called that larger triangle pattern complete. Now we're moving up impulsively in what looks to be 1, 2, 3, 4, up and 5 with a larger 1, 2 in formation. So I've been telling you guys to get in on these gold miners, not necessarily gold itself, but I will say that what I'm seeing here is more likely we're coming down in A, we're going to do up in B, down in C. There's going to be a bigger opportunity to pick up on these guys. This week, gold miners, kind of a mixed performance bag here, a lot of negative performance. Looking at the weekly RRG, and if I animate this again, we had all of these gold miners in this lagging condition. A few of them attempted to push over into the lead. I told you, hang on, that's a false start, don't go yet. And now we're getting this, as we got that triangle completion in gold, now we're getting this huge, massive run, which I'm calling the gold rush of 2022. So take time to take a look at the stocks that are make up in this group here, and I think you'll find yourself some opportunities coming up very shortly to make some substantial upside moves in the gold miners. All right, well that's going to be it for me. I'll hand it back to you and Bennett, Todd.
Very good, Terry. Let me
go ahead, Bennett. Go ahead.
Yeah, no, I was just going to grab the screen really quickly. Terry, if you could pass me presenter. I've got one last chart I want to show here. All right, screen 2. All right, you should have my screen coming up. Okay, perfect.
Oh, here we go.
So, you know, Todd brought up an excellent point earlier in regards to market sentiment, and we really, this is something that we have found has been going on for quite some time. There's been a lot of really intelligent investors and traders who have missed out on a lot of really even the post-COVID low rally. We just hosted a webinar last weekend, I believe it was, and in the webinar was titled Navigating Volatile Trends, and what we looked at were a series of headlines from what could be considered, you know, very reputable analysts and economists who were suggesting, you know, 40, 50, 60, 80% corrections. And, you know, what we found were a lot of those dated back to April and May of 2020. And a lot of those individuals have, intelligent individuals have missed out on a large portion of this move post-COVID low. And as we were coming off of kind of the late 21, early 2022 highs, we started to see that really bearish shift in sentiment once again. And both Todd and myself were fairly vocal about our view that this was simply a corrective pullback.
Well, you're being too generous. You and I on our strategy session call brought it to my attention, and I said, "Yep, that. I mean, couldn't be any clearer."
It illustrates it so well. It really does. You know, and you know, going into for the SMH obviously being a key industry group within technology. If in fact this was truly a shift in underlying sentiment, we would not expect to see momentum divergence into new lows. This is just kind of a garden variety 3-wave pullback. And we felt that this was one of the most important charts to kind of explain the growth story and what we were seeing in the markets, and why I said at the webinar, I feel now more than ever is it important to focus on the hard right edge of the chart and what that is reflecting, especially as we navigate the volatility and uncertainties that this year has brought us. So that's all. I just wanted to throw that in there.
Yeah, no, it's a good point. I mean, I just look at, so you said just you know, running portfolios and talking to clients and counting on the work, you know, that my guys at Trading Analysis do. It's so important just set your emotion aside. My partner Ryan wrote a great article on the New Age Wealth website, just talking about pretty much the premise of why we named our wealth management business the way we did, which is just so much noise out there. There's so much information. The speed of information is insane, and it's why it's so important to run portfolios both with good understanding of the fundamental, the macro themes, but then look at the technicals and figure out what's actually happening at the hard red edge of the chart. You look at charts like Tesla. I mean, guys, did anybody see how perfect of a correction this was in Tesla? I mean, it was textbook, and now it's leading on the upside. You go to Apple. Is there anything, I'm taking a more simplistic approach at this point, but the highs in Apple coming from 180 down to 150, nothing impulsive about that. And I know Bennett and the guys are looking at several different possibilities of where that fits in, but there's a lot of corrective structures coming in, and Terry mentioned it. Let me see if I can pull this chart over. How growth has come back, and there's a lot of discussions out there about where the yield curve is and spreads between treasury yields. Is there a coming recession? And there's a lot of debate out there, and I'm telling you, a lot of people were not expecting the move back that we've seen in certain industry groups. And just to take it a step further than where Terry went, so this is going to be a relative rotation, and I benchmark it against the VTI, so the total stock market index, rather than the S&P, which is obviously very heavily large cap weighted. And if you just see it, this is a similar message as what Terry was giving you in terms of growth and value. You have value, and this is the weekly, by the way. So this is every little dot represents 1 week. So you've got the S&P 500 value. This is, I believe, mid cap. That blue is kind of hard to see, starting to turn down sharply. You have the 500 growth, which is going to be large cap growth. The fact that it's not as left on the screen as the other two indicates relative strength. But the move up that we've seen recently in small and mid cap growth, I think, is very, very telling, on top of what you saw with semis. And I'm not trying to be ultimately bullish. I'm not. I continue to be a trader, and I approach our portfolios in that manner. But the pullback that we've seen was I think fairly insignificant when you put it in the context of so much being thrown at the market. You have geopolitical stress, you've got inflationary stress, you've got the tail end of a pandemic. The fact that the market was only off 20% in the Nasdaq max, maybe 16-ish percent, 15% in the S&P is pretty impressive. So does anybody want to talk about the yield spread? Is anybody confused? Does anybody want to hear about it, or do you guys want to just start trading here as the market just open? So many people listening to my friends on CNBC talking about the 10-2 yield curve spread and why recession is imminent and why you need to get out of stocks. We kind of took a different tack, which is like you're looking at the wrong yield spread. 10-2 is not the shape of the curve that determines the health of the economy. So if anybody wants to jump into that, I'll just touch on this quickly. Basically what's going on here is the spread that I think actually matters is where the Fed operates. The Fed operates, I think, less than 1 year, at a maturity shorter than 1 year on the yield curve. And you start to look at the 210 spread, and I can pull that up quickly, and you'll start to see that you are getting a little bit of inversion. So let me just bring this up, 10-2 spread. And I'll pop it over the S&P. And we'll go out here just a little bit. Well, that was fun. I really don't feel like going through all that again.
Technical difficulties.
Don't you just love
happens to the best of
technology?
us.
I haven't done this stuff in a couple of years.
It's been a while, yeah.
It's been a while. All right, let me go back. So just real quickly, this is the annotation I was showing. Sorry about that, guys. 10-2 spread. Okay, so in purple over the S&P, When it's high, it sets up into an expansionary period. So from here, 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 here. You look at where the 10-2 spread was from the beginning, it was nowhere near where it should be to start off a pretty significant expansion. So I think something has changed in the market if you want to focus on the 10-2 spread. But again, the Fed operates, I think, less than a 1 year. And if you want to look at, financials have been leading the upside here. Financials, they make money from something called the net interest margin. You give the bank your money, they pay less than 1%, usually you lend it to them for less than a year. They take that money, lend it out 10, 20, 30 years at 3, 4, 5%, and they capture the spread. And I did some research on this. The average loan maturity, okay, on the short end where they borrow is less than 1 year, and those rates are still well below where the 2 years is suggesting. So maybe the Fed, even if the Fed hikes 7 times, it's still going to create what I think to be a normally shaped yield curve. And I love the dynamic yield curve over here on stock charts, and it gives you a good visual representation of where the yield curve is. See how low the 3, 1, and then all of a sudden you get up to the 2 year, then we start to flatten out in the middle part of the curve, right? So what I say is this yield curve is still very much normally shaped, which is the shape of a healthy yield curve. If the Fed is going to raise 7 times, so 7 1/4 is 7 times 0.25, whatever, is that 1.75%, right about here, if the Fed raises 7 times this year. So even then, okay, then we'd argue that this is an inverted yield curve. But if you go back and look at a true yield curve inversion before 2007, that's yield curve inversion. Short end is longer than all other maturities. You go back here, 2000, that's clear yield curve inversion. We're a long ways away from that, guys. And everybody, I find it kind of annoying how saying, oh, recession watch, 210 is inverted, barely. One, there's an 18-month lag on that. And two, you've got to be looking at 1 year and less. And then, I've been talking about this for several days. And then I log in. I don't know if Barron's is still going to have it on the front page, but then it was the head. It still is. It's the lead article on Barron's here. The yield curve is close to inverting. A different curve tells us a more upbeat story. And they're basically just going to the 330 yield, or the 310s, 330s, which is the 3-month, which is more indicative of where the Fed is. So let me see if I can find this 10-month 3 yield, and I'll throw SPX on this. Okay, so the purple is the 10-month, 3-month spread. It's not only not flat, not inverted, it's going up. Okay, it's going up. This is now, actually, wait a second. This is a chart I do want to show you here. Let me see if I can get the current one right here. Okay, and I'm going to finish with this. Let me just do 3 year, 1 year. Okay, so there's a lot going on in the chart. Let me just get rid of everything but the 10-3 spread. This thing is ripping higher. Okay, that's good. That's the shape that you want to see for a healthy economy. I'll throw the S&P on here. Okay, you can see there's a pretty good inverse relationship until the S&P started to regain its mojo here. You throw crude oil on there, and then you see something interesting. Crude oil in blue, we got a little bit of a spike. The yield curve started to move higher, and the S&P sort of did one of these. And I was trying to draw a comparison, same chart back to 90, 91 at the first Gulf War. The same thing happened. Crude oil spiked. S&P sold off, 3-month, 10-year spread moved higher, and we set up a significant bull market into the 90s. It's kind of interesting what's happening in here, and basically I'll stop it here, and I'd love to get your feedback, guys. I think inflation is here, obviously. I think people realize there's still no alternative. We're still a long ways away from treasuries paying an acceptable yield, which is called the break-even yield. Stocks continue to be the only game in town, and if inflation truly is going to be here, I think what's going to happen is the curve, I don't think, is going to invert. I think the whole curve shifts up. Treasuries are selling off because they realize it's a feudal game. The 60-40 portfolio is dead. It's been dead for a decade. So that just puts the spotlight back on stocks. And I think the whole yield curve shifts up. And I think you're going to see a new relationship as stocks come back, whether it's going to be growth or whether it's going to be value. Terry mentioned that we're just starting to see the hook down there, but the value trade has been fully, I think, played out. We've been long energy, we've done well on it. We've been long industrials, we've been long financials. That trade has worked. I've had that on since we launched 6 months ago. Before all the Russian situation happened. So again, very few people are talking about it, but watch, I think, a general move up in the yield curve, and tech and growth may be coming back in. I'm not making a prediction, but we'll certainly, we're going to be looking to position our portfolios that. And that's, that everything you saw from the technicals earlier, why we're seeing good corrective patterns, especially in the semis, I think it all kind of ties in. So it's interesting. Guys, what do you think?
Well, as you demonstrated, there's more room for them to move up without technically causing the inversion. And the Fed cannot manipulate the long-term interest rates. The market itself, the economy has to grow that. So, I think your demonstration there proves that we shouldn't be quite so worried that growth is going to go away immediately or face negative economic pressure due to those higher interest rates. That's and that right there in itself says these companies are going to continue to outperform up until, if the Fed has to continue accelerating those interest rates past that 2.3% mark, and then the rest of the economy gets sluggish, then eventually we will get that yield curve inversion. But you are correct, it's not happening tomorrow or anytime probably in the next 6 months from what I see. Therefore, I think we have this other opportunity for another push higher back up in growth stocks.
100%. And the Fed's not going to get there. We couldn't even hike 50 basis points this meeting. And now it was a month ago, the probability was 80% of us going 50 in March. That came right off. And here we go again. Fed fund futures are pricing in 50 in May. Like, oh yeah, May, we're going to be doing it. You have no idea what's going to happen next meeting, let alone 7 rate hikes from now. Like, I just I hate to say it, but the arrogance of which some people speak, knowing with certainty how the market's going to behave a year and a half from now is just shocking to me. The Fed is not going to raise rates on the short end to push us into recession. They're vocalizing it. They're telling us to prepare for it. They're talking tough. Powell says he's going to be acting on his feet. Every conference he says meeting is going to be live. He's going to determine at that time, what's appropriate for the particular situation. So my point here, guys, is use the technicals, understand the fundamentals, understand the macro flows, and dismiss what the general consensus is. Because again, I love a lot of my friends who I listen to in CBC, but people are just shouting from the rooftops how this is just a bear market rally and 10-2 spread is saying recession's imminent. I'm like, it's just you're costing people more and more return, and this is why we launched the wealth management business. So many people are coming to us. This is a natural extension from trade analysis, the business I launched 10 years ago, a decade. We always trade responsibly with a defined amount of your capital, and always recommended that you trade with a defined amount of your capital and bucket out, compartmentalize those 2 trading accounts. You're investing in your trading. It's so important that you can't have the 2 mix or overlap. And unfortunately, so many people have been cost a lot of valuable returns trying to outguess and fall victim to all the scare tactics that are really just designed to get your eyeballs so they get their advertising revenue, and dude gets more Twitter followers and stuff like that. So obviously you can tell I feel passionately about it, but I've only been doing this for, I don't know, I've been trading, my first professional job was 01, so only 21 years, started trading 23 years ago. There's been something wrong almost every quarter of my entire career. Like, there's always something wrong to focus on. So hopefully that helps and give you some context. The clients that are coming on, I say continue to trade with trade analysis, carve out a good percent of your account, stay involved in, but make sure you separate out. And a lot of people can't separate emotionally that long-term bucket. That, let me just finish with this. I'll throw up the chart and then I'll shut up. But I just, this is why I'll throw Apple, that's fine. Let's just keep that in mind. Like, just everyone take a big step back. This is a 1 month from 2003, so let's call it a 2-decade chart of
Can you
Apple.
zoom out a little bit?
I mean, can you
Can't see any
guys?
scales?
That's all right. Oh, sorry. Thanks. Let's see if I can do this here.
There we go.
This is a good exercise, you know, because obviously we have some of the most capable chart analysts on the internet. But I just like to just put it in the nude, put it in the raw, take a step back and say, can you see a coming recession in that Apple chart? Do you see, you know, okay, how about RSI divergence? Well, it diverged back in 2013. Okay, if you've been waiting for RSI divergence, you've missed a decade of hundreds of percents of return. Like, what do you see in this chart that tells you it's over? I mean, we can even do it in the SPX, and then I got to go. I'm just trying to give you this longer term perspective. Again, just step back. What do you guys see in that chart that tells you recession and a pullback and a bear market is imminent? I don't know. I don't see much. Anyways, I missed you guys. I missed the trade analysis team.
Good show, man. Good show. Thanks for doing this.
Yeah, happy we could pull it off. Thanks for letting me guest host, I should say. Maybe,
sure,
hopefully you guys are all safe in
it.
Texas. I know you guys have been through hell, so, man. My whole trade analysis team, we've got our amazing customer service guy in Kiev. We've got, you know, the two top guys in Texas getting hammered by tornadoes. Everything okay with Alex?
On the first day of spring.
On the first day of spring. Alex okay?
Yeah, I just spoke with him. He had a therapy appointment this morning for his neck, so he was got delayed there a little late. He will be back with us next week, and of course tomorrow morning, 9 a.m. for Crypto Lab.
Did he get whiplash on this rally back?
I love it.
All right.
Check Alex out on his Crypto Lab tomorrow, guys, and get the lowdown on Bitcoin. I think there's an interesting turn of events there. I won't reveal that to you, but you guys check it out on the Trading Analysis YouTube. All right,
Perfect.
Bennett, we got a client webinar here coming up in 10 minutes, guys. Thank you for joining us today.
Looks
Very
like I'm
good.
on it.
Thank you very much, Todd, also for hosting, stepping in at the last minute, and saving the day. Appreciate it.
No problem. Guys, looks like I'm going to be on CNBC at 2 o'clock today. They just emailed me.
2 Eastern?
2 Eastern, yeah.
Awesome. Sounds good. Clients,
See you
we'll
guys.
see you in about 10 minutes. Todd, Terry, good stuff. And viewers, we'll see you guys next week.
See you guys.
Take care.
Appreciate a thumbs up.